You're welcome back to the program. I'm Charles Aitim. The debate over high lending rates in the country continues as the Institute of Economic Affairs (IEA) is blaming the high cost of credit on government, banks, and the Bank of Ghana for that matter. Though it believes the problem is multifaceted, the IEA is laying the blame at the doorsteps of these three actors. Director of Research at the IEA, Dr. John Kwache, has been speaking at the Policy Forum on high lending rates.
Whilst the spread between lending and policy rate is about 7%, that of lending and savings rate is about 12%. Director of Research at the IEA, Dr. John Kwache, said cost of high and currency differentiated reserve requirements can also be blamed for the high lending rate. He therefore wants the three actors to collectively fix the problem, though he wants the Bank of Ghana to consider capping interest rate spreads to regulate lending rates.
We can also say with some confidence that the problem, may be placed at the doorsteps of three key actors in the economy. These are banks, government, monetary and regulatory authority. And that's how I call the central bank. They are a monetary authority, they are also a regulatory authority. So that's the central bank. I'm saying that all these three key actors should take responsibility for the high lending rates. And if they are responsible for it, then they should also be part of the solution.
Dr. Kwache made some recommendations in order to address the high lending rates, which he described as contributing to the high prices of goods and services in the country. On the part of the banks, he urged the financial intermediaries to reduce their operating and overhead costs. For government, he called for the reduction in borrowing from the domestic market, but urged the Bank of Ghana to reduce the primary reserve ratio from the current level of 8% to 5% to reduce the associated cost to government.
Reduce your paper load, economize on your time, avoid unnecessary location dependency, reduce incidence of staff delinquencies. It's just that all the things that increase your costs, I'm just asking you to do something about them. That's all. Now, you should reduce your operating overhead costs and so on, labor costs, material, equipment, and so on. Strengthen your capacity to appraise customer projects so that you reduce the incidence of loan defaults and all these things. Then government. Now, again, government should do something about its borrowing from banks. Okay, so you keep the deficit under control. Okay, now.
Chief Executive of the Ghana Association of Bankers, John Ewa, told Joy Business that the argument about high lending rates in the country is misplaced. He disagreed on the proposal that the Bank of Ghana should consider capping interest rates since it could result in unintended consequences.
The talk has been banks' lending rates are high, and we think they've been a bit misplaced because we're not taking the totality of all the factors that generate that lending rate. When rates or market rates have come down, the lending rates have followed. And if you trend the last 5 years, you see clearly that the bank lending rates have reduced from upwards of 28 to 29%. Now we are talking about 20%. A lot of banks are lending to good customers at below 20%. So it is a matter that I think we have not sold our story properly. And I think the general rhetoric has been lending rates are at some levels that are unmanageable. But we think that if market fundamentals continue moving in the direction that is moving downward, lending rates automatically will follow.
Factors such as cost of funds, treasury bills rate, non-performing loans, and inflation contribute significantly to the high lending rates. Studies have also shown that the high lending rate inhibits investment and economic growth.